Hello. Today we're going to talk about integrated reporting. Now, integrated reporting is not the most fascinating topic. It is fairly dull. However, it is something that is important in our universe of accounting, and it's a topic you should know. Integrated reporting was initially developed in the United Kingdom. This concept remains much more popular internationally than it is in the United States. Before we get into these details, we do need to understand that integrated reporting is strictly an incremental, additional type of communication regarding a business. There is no requirement, zero requirement by government agencies or accounting oversight organizations to use integrated reporting. This is a voluntary form of information disclosure. So why haven't you heard of integrated reporting? Because it's new, it's completely optional, it was not born in the USA, and it's not widely used. A recent paper which discussed integrated reporting stated that 29 companies based in the United States have adopted some form of integrated reporting in 2017. This topic is entirely what I would call conceptual or theoretical. Many of my students might classify this topic as fluffy because there are no debits, credits, journal entries, or financial transactions. You will not need your calculator to answer a question regarding integrated reporting. Integrated reporting was likely not covered in whatever managerial accounting textbook you used in college. Even if the textbook included this topic, it was likely discussed in one of the later chapters of the book, which not all accounting professors have time to teach. Other forms of what we call advanced performance reporting, that would be the title of the chapter, okay? Other forms of this have been developed and discussed over the past 25 years, including cost of quality, triple bottom line reporting, and sustainability reporting. So what is integrated reporting? The official definition goes like this. Integrated reporting is a process founded on integrated thinking that results in a periodic integrated report by an organization about value creation over time and related communications regarding aspects of value creation. So if we were giving prizes for definitions that use words multiple times, this definition would be a big winner because it uses the word integrated 3 times and the word value creation twice. Unfortunately for us, none of those words have particularly concrete or universal definitions. So what exactly is being integrated? One could say financial data and non-financial data, past results and pro forma projections of future results, business strategies, plans and outlooks, business competencies, risks and challenges. That's a lot of integration. Many of the items on this integration list fall within the responsibility of managerial accountants. Managerial accountants are frequently the team that brings together financial and non-financial data and also develops the what-if projections to support the business strategy. The guidelines for integrated reporting use the word periodic, which is not annual, semi-annual, or any other specific time frame. Keep this in mind. There are no regulations regarding timing. In fact, there are actually no regulations regarding integrated reporting at all. The other concept mentioned in the definition is value creation. And we have a diagram that reflects that idea. We'll get to that in 1 minute. The definition of integrated reporting, along with integrated thinking, is contained in a framework. This published document, available for no charge at the internet, was published in 2013 by the International Integrated Reporting Council. This organization is based in the United Kingdom. You may be familiar with the framework, which was developed by COSO, which discusses internal controls. That framework is widely used by internal and external auditors. The framework for international integrated reporting is similar in many respects to the COSO framework. Both of them are subject to interpretation, and both of them are fairly wordy. Well, here we have the value creation diagram. The diagram begins on the left-hand side with the 6 capitals. The 6 capitals then come together in the center of the diagram into the organization's business model. The business model takes inputs, performs business activities, generates outputs, and creates outcomes. The right-hand side of the diagram illustrates the 6 capitals again, but now the colorization or the shading of each of the 6 capitals is darker or bolder to reflect improvement or enhancement. And of course, this diagram contains a feedback loop. Value creation, as defined in the integrated reporting framework, is this: the process that results in increases, decreases, or transformations of the capitals caused by the organization's business activities and outputs. The 6 capitals. I have invented a mnemonic called Fishman, and I find the mnemonic quite helpful. You may want to write this down. Here are the things in Fishman and the 6 capitals. They're financial, intellectual, social, human, manufactured, and natural. We'll start with the financial capital. The financial capital is a pool of funds. We are talking about money, so this is a very literal definition. This pool of funds is available to an organization for use in the production of goods or the provision or purchase of services. The funds are obtained through financing, such as debt, equity, or grants, or the funds are generated through operations or investments. As such, retained earnings is a part of financial capital. Intellectual capital is organizational, knowledge-based intangibles, including intellectual property, such as patents, copyrights, software, rights, and licenses. So any software developed internally, even an Excel spreadsheet, would be considered intellectual capital. Intellectual capital also includes organizational capital, knowledge, systems, procedures, and protocols. Sometimes we see how businesses operate and we see the system that they use. That would be considered intellectual capital. Social and relationship capital includes shared norms, common values. Here we're like meaning human values, not financial value, okay, human values, and behaviors. Key stakeholder relationships with vendors and customers, community members, the mayor of your town, all those relationships. It includes alliances, consortiums, trade groups, and other examples of a company working with an outside group to achieve a goal. Human capital is people's competencies, capabilities, and experiences, and their motivations to innovate. Organizations can improve and increase their human capital through training programs, support for continuing education, and certification programs. Attainment of the CPA, CMA, or other wonderful certification would be an element of human capital. Manufactured capital is defined as manufactured physical objects, as distinct from natural physical objects. These manufactured objects are available to an organization for use in the production of goods or the provision of services. So examples would be buildings, equipment, infrastructure, like roads, ports, bridges. They even mention water treatment plants and waste treatment plants. Another big element of manufactured capital is inventory. Sometimes because it's working capital, we don't think of it as a part like it would fit with the property, plant, and equipment, but inventory is in here as a section of manufactured capital. Also tools, patterns, and molds that a company would make or use in its production process. Some of the manufactured capital items can be found in the fixed asset ledger, listed as property, plant, and equipment. But don't forget, inventory is a part of this manufactured capital as well. And last but not least, natural capital, which is defined as all renewable and non-renewable environmental resources and processes that provide goods or services that support the past, current, or future prosperity of an organization. So natural capital would include air, water, land, minerals, forests, a biodiversity situation, and ecosystem health. Fishman, the 6 capitals of integrated reporting: financial, intellectual, social, human, manufactured, and natural. Okay, we're going to go through another list. The integrated report, which is the output of integrated reporting, requires or suggests, doesn't require anything, it suggests 8 content elements. The framework lists the 8 content elements, and we're going to review each of them in a minute. But let's remember that integrated reporting is relatively new and completely voluntary. Of the 29 organizations I mentioned earlier that have adopted integrated reporting, very few include all 8 content elements in their integrated report. Adoption or implementation of this integrated reporting concept is a continuum. Please remember this if you ever see an essay question regarding this topic. Because it's new and voluntary, one could easily surmise that companies will embark on this concept rather slowly in certain facilities, product lines, or divisions. Large multinational organizations won't produce integrated reports for the whole entire organization, which include all 8 content elements on the first try. They may start with a small segment of the organization, and they may choose to include only some of the 8 content elements. In the ideal world of integrated reporting, which is in the future, all businesses would provide an integrated report for each of their business units, containing all 8 content elements. In that world, an investor, a person who holds financial capital and is looking to invest, they would only have to look at all the integrated reports to best determine where to invest. We'd have common, similar report structures that have all the 8 elements, and we could all understand them. But we're not there yet. All right, back to the 8 content elements. I've developed another mnemonic for remembering these 8 elements. I'm calling it Groom Pops. In case you don't know what a Groom Pop is, here's a quick illustration. Have you ever seen or eaten a cake pop? That's what they look like. They're colorful, tasty, like frosting on the outside. Now, for a wedding favor, they make these cake pops and they decorate them to look like a bride and a groom. Okay. For our purposes, we're just focusing on the groom. Okay. Groom Pops. I'm going to discuss the content elements in the order of the Groom Pops mnemonic. I'm going to list them first. Governance, risks and opportunities, organizational overview, 2 O's, and external environment, business model, performance, outlook, preparation and presentation basis, and finally, strategy and resource allocation. Okay. The first element is governance. In this portion of the integrated report, this question should be answered. How does the organization's governance structure support its ability to create value in the short, medium, and long term? The answer to this question regarding governance would likely discuss the role and composition of the board of directors, senior management positions, and any noteworthy changes expected in these positions or duties. The next content element is risks and opportunities. What are the specific risks and opportunities that affect the organization's ability to create value, and how is the organization dealing with them? In my opinion, this content element is wide open for interpretation. A firm could use the risk assessment portion of an internal control report to complete part of this content element. Some entities might be reluctant to disclose all of their future risks and opportunities, citing concerns with losing those opportunities to competitors. That said, if the real idea of integrated reporting in the ideal world is to help financial analysts more efficiently allocate capital, those analysts should understand the opportunities a company sees for growth. The third content element is labeled Organizational Overview, 2 O's, and External Environment. The question to be answered in this area is simply, what does the organization do, and what are the circumstances under which it operates? Here is where an entity would discuss its culture, ethics, and values, along with principal activities and markets, competitive landscape, market positioning. Within this content element, a company might provide some quantitative information, like number of employees, amount of revenue. They also could list the names of countries in which the organization operates. The fourth content element, out of the 8 in total, is the business model. We could look back at the value creation diagram, which had the business model smack in the middle in the circle. The business model, as discussed in the content element, should include key inputs, business activities, outputs, of course, and outcomes. The term inputs suggests a massive list of items which the organization uses to develop its products and services. The framework does state that an integrated report does not attempt to provide an exhaustive list of all the inputs, but the focus is on the inputs that have a material or significant bearing on the ability to create value. Clearly, judgment has to be used to determine which inputs are significant. Business activities in the business model list what the organization does to transform inputs into outputs. Outputs are the key products and services that an organization provides. Now, there may be some other outputs, such as byproducts and waste, including emissions. Outcomes is the final piece of the business model, and that might include revenue, cash flow, employee morale, organizational reputation, and customer satisfaction numbers. The fifth content element is performance, P for performance. We include that in the integrated report, of course. This section discusses what has happened in the past in terms of each of the capitals. So this historical data we could classify as lag information. This section would certainly include quantitative data, some of which would be sourced from the annual report or the 10K, but some of which would include significant discussion of qualitative data, such as employee training, the formation of new relationships with suppliers, and again, customer relationships. Content element number 6 is outlook. Here's the question that the framework suggests that we answer. What challenges and uncertainties is the organization likely to encounter? And what are the potential implications for its business model and future performance? So we said just a few minutes ago that the performance content element was a lag element. Well, the outlook content element is a lead element. The organization could report on all the same items as in the performance section, but with forecasted data instead of historical data. The seventh content element is preparation and presentation basis. This explains how this integrated report was designed and developed, what's in it, what's not. This section might include a summary of the materiality determination process, a description of the reporting boundaries and how they were determined, and the definition of those timeframes. What exactly is meant by short, medium, and long term? This section should explain why certain areas of the business might not have been included in the integrated report, and if that situation is going to continue. If an entity has a plan to expand integrated reporting by including more segments of the business, or by including additional content areas that they've skipped in prior years, they would include that in this section, preparation and presentation basis. The eighth and final content element in an integrated report is strategy and resource allocation. According to the International Integrated Reporting Council, an integrated report should answer this question: where does the organization want to go, and how does it intend to get there? An integrated report ordinarily identifies the short, medium, and long-term objectives of the organization, the strategies it has in place or hopes to put in place to achieve those objectives, and the resource allocation plans it has to implement that strategy. It also should mention how it's going to measure its achievements and targets. Let's review the Groom Pops Pneumatic one more time. At the top we've got governance, then risks and opportunities, organizational overview, there are two O's are there, business model, performance, outlook, preparation and presentation basis, and finally, strategy and resource allocation. So why would an organization adopt integrated reporting? What are the benefits? The developers of integrated reporting have identified the elements or aspects of an organization which they think are most important to stakeholders outside of the organization, especially providers of financial capital. The providers of financial capital are the ultimate customers or recipients of integrated reporting. Integrated reporting provides a clear, condensed version of an organization's annual financial report, guidance, mission, vision, competencies, relationships, governance in one single place. From a big picture, kind of forest perspective, this approach provides a more cohesive, consistent, organized approach to corporate reporting. When, notice they say when and not if, when most major organizations adopt integrated reporting, comparing one entity to another will be more straightforward, resulting in a more efficient allocation of financial capital. There are challenges. There are lots of challenges with implementing integrated reporting. This concept is really complicated for organizations with multiple divisions, subsidiaries, and operations. A separate integrated report with a unique, colorful value chain diagram would be required for each business model. This is burdensome for small and medium-sized organizations. Unless integrated reporting is allowed to replace any portion of a 10K, or any statement regarding internal controls, integrated reporting will become an additional, incremental work effort. There are no reporting standards. Judgment must be used in determining how much to report, how the report should look, and that's going to result in inconsistencies between integrated report formats for similar organizations. Such inconsistency would appear to negate the benefits of common comparable reports. An organization that adopts this is going to incur additional costs for no quantifiable benefits. The benefits described in the integrated reporting framework are qualitative. There are no headcount reductions. No productivity improvements are going to occur as a result of adoption of integrated reporting. The forward-looking content elements, particularly Outlook, might breed litigation risk. Providing information regarding the opportunities which may lie ahead for an organization in the short, medium, and long term, and then explaining how the organization is going to deal with these opportunities may be seen by some stakeholders as predictions or promises of future benefits. So if those opportunities don't come to fruition, some stakeholders may resort to litigation. So what should you remember about integrated reporting? Integrated reporting is being used across the globe. Entities around the world are starting to do this, and the number of users has grown each year since 2013. An integrated report contains information about 6 different capitals. Fishman. Those capitals are used by an organization and they're generated as the organization goes about its business. Integrated reporting framework lists 8 content elements, Groompops, and ideally all of those are included in an integrated report. While complete inclusion of all 8 content elements may not occur for all users right away, there has been a general trend in our world of accounting toward dissemination of more non-financial information to stakeholders. Adoption of integrated reporting is typically a multi-year process, and many organizations will use a phased approach to implementation. Collection, coordination, and reporting of both financial and non-financial information as it relates to an organization's value chain has long been the domain of accountants. Integrated reporting is an important development within the accounting profession, and wise accountants should be conversant on this topic.